everyone. Welcome to Business Morning. I am Bisi Adebayo. We begin with oil prices, which inched up in early trade today as oil workers evacuated rigs in the U.S. Gulf of Mexico ahead of Hurricane Delta. The fuel demand concerns persisted and fading chances for a U.S. economic stimulus deal and the build in U.S. crude inventories. Brent crude futures rose 0.2% to $42.08 a barrel, while U.S. WTI crude futures rose 0.1% to $39.98 a barrel, and that's after falling 1.8% on Wednesday, with Hurricane Delta forecast to intensify into a Category 3 storm with winds of up to 120 miles per hour. Oil producers have evacuated 183 offshore facilities and halted nearly 1.5 million barrels per day of oil output. According to the U.S. government, the Gulf of Mexico produced 1.65 million barrels per day in July, which accounts for 17% of U.S. crude output, but has been hit by several storms over the past few months, each of which only briefly dented oil output. In other headlines, Nigeria's former Finance Minister Dr. Ngozi Okonjo-Iweala and South Korea's first female Trade Minister Yoo Myung-hee have emerged as the final two out of the 5 candidates in the race to lead the World Trade Organization. And this comes after members of the European Union endorsed both women as candidates to lead the 25-year-old Intergovernmental Trade Organization earlier this week. However, WTO General Council Chairman David Walker plans to formally announce the results to the institution's delegates this morning in Geneva. Meanwhile, a third and final round of consultations will begin later this month and is scheduled to run until November the 6th, when the WTO aims to agree by consensus on the next Director General on November the 7th, amid concerns of U.S. support for the final selection. And back home, the Senate has approved and passed the 2021-2023 Medium-Term Expenditure Framework and Fiscal Strategy Paper, proposing a budget size of 13.08 trillion naira and fiscal deficit of 5.19 trillion naira. The Senate's approval of the MTF follows the consideration of a report prepared by the Committee of Finance and presented by its chairman.
Going by the very difficult times in which our country and indeed the global community have found itself as a result of the COVID-19 pandemic, and on our own domestic challenges, it is clear that it cannot be business as usual for this Senate and indeed the National Assembly with respect to their representative, oversight and lawmaking function. Therefore, this Senate and indeed the National Assembly must more than ever before collaborate with the executive to ensure effective and full implementation of the 2021 Medium-Term Expenditure Framework and Fiscal Strategy Paper and subsequently the annual budget thereof.
Nigeria as a nation, we are also battling back.
And with respect to borrowings in the 2021 fiscal year, the Senate is approving new borrowings of 4.28 trillion naira and debt service estimate of 3.12 trillion naira. Now, the MTF report raised concerns of how many revenue-generating agencies are failing to meet revenue targets, and some of them engaging in frivolous spendings, a situation which worries lawmakers.
What is so worrisome is the fact that our borrowing is about 4 trillion, while loan repayment is 3.2 trillion. Debt service, 3.2 trillion. By the time we add up these two, it has more or less swallowed our revenue projection, which is 7-point-something trillion. So we're actually borrowing money to pay our salaries, to live as Nigerians now. And it really calls for serious concern, a situation where our revenue for the year is almost equal to our borrowing and our debt service. And it's really worrisome because for me, as a nation, I think we are just doing a lot of motion without movement.
And in about an hour from now, President Muhammadu Buhari is expected to present his proposed 2021 budget estimate of 13 trillion naira to a joint plenary of the National Assembly. And the budget, which is designed to enable the country attain inclusive growth, has a crude oil benchmark of $40 per barrel, the oil production estimate of 1.86 million barrels per day, and an exchange rate of 379 per dollar as some of its key assumptions. It's also President Buhari's expectations that the proposal will stimulate the economy, create jobs, and enhance investment. Well, joining us to discuss this development now is the Chief Executive Officer of Cowrie Assets, Mr. Johnson Chukwu. Good morning, Mr. Chukwu, for joining us on the program. Now, just before we drill down into the 2021 budget, how will you assess the impacts of the January to December budget cycle, which took effect this year?
Thank you, BC, for having me. Well, the ideal thing is to revert, which the government is trying to do, to the January to December budget cycle. But unfortunately, for this particular year, the interruption from COVID has actually completely offsetted whatever benefit that we stand to gain from that new budget cycle, because we saw an economy that was locked down for almost 6 months in 2020. So we have not yet we're not likely going to enjoy the full benefit of having a budget cycle that is running from January to December. But that does not distract from the fact that the government needs to, as the president is about to present the budget today, we need to now stick to the January to December budget, because the benefit of it, among others, is that there's no uncertainty at the beginning of the fiscal year, and business leaders are able to plan their business operations, knowing what the government plans to do and what the government plans not to do. Secondly, the government is in a position to disburse budgetary allocations in January, so that particularly fiscal infrastructure development can take place before the onset of the rainy season. Previous years, when the budget was passed in May or June, you realize that no major capital expenditure is actually developed or incurred, because at that point we'll be at the peak of the rainy season. So the benefits are multifaceted, but I think the government is pushing to stick to this regular January to December budget cycle.
Now, how will you describe the single act of the President's presentation of the proposed budget to the National Assembly today?
Well, like I said earlier, it's actually pleasing to know that the budget is coming in the first week of October, which gives the National Assembly the opportunity to review the budget and pass it into law, so that the president can sign it into law before the end of this year. And that will eliminate a lot of uncertainty. A couple of other things have also been done as it relates to the budget the president is presenting. The Minister of Finance said that about 60 government-owned enterprises have been incorporated into the federal government budget. That could also explain the reason why you saw an increased projected revenue of about to 7.89 trillion naira at a period when, if you compare that to last year, when we only generated about 4.1 trillion naira. And the minister did say that only 10 government-owned agencies were in the 2020 budget, but now we're going to have 60 of them, that excluding NNPC and the central bank. The rest are now incorporated in the budget. That will also lead to some better improvement in planning and execution, as well as economic management.
Well, now let's talk about the proposed budget assumptions now. There's an exchange rate of 379 naira, a crude oil production of 1.86 million barrels per day, a GDP growth of 3%, and inflation still a double digit of 11.95%. How realistic are those assumptions to you?
Well, I would say, let me start from those that look quite realistic. The budget crude oil benchmark of $40 looks realistic. In fact, it's expected that depending on the direction of the American election, that oil price could actually move beyond $40 average next year. I mean, we're going to see reasonable recovery in the global economy. Just like IMF managing director said that the global contraction this year is going to moderate below the 12% they had projected. So next year, most analysts are projecting that the economies will begin to recover. So I expect the $40 per barrel is achievable. The benchmark, the crude production target of 1.86 million barrels also looks realistic, given that of that 1.86 million barrels, 1.46 million barrels is going to be crude, and about 400,000 is going to be condensate. And I know we are producing between 400 and 500,000 barrels of condensate. So we're going to stick to the OPEC quota of about 1.5 million barrels. That also looks achievable. The challenge will come from areas like inflation target, inflation of about 11%. It looks unrealistic because we're expecting inflation to trend further northwards. We are currently at an inflation rate of 13.2%, and the projected, even the central bank projection is that we're going to hit inflation target of inflation rate about 14% this year. So it might be difficult to for that rate of inflation to unwind or moderate down to about 11% next year. That's one factor. And again, remember that the budget that the president is going to present today is a highly expansionary budget that will inject liquidity into the economy and rather push up inflation instead of moderating inflation. I think the inflation target looks very optimistic. But beyond that, the overall revenue projection also looks very optimistic. Projecting a revenue of 7.89 trillion naira in 2021 might be a tall order. Remember also that the minister said that the budget, 2020 budget, as of July 2020, had only achieved 68% revenue target, projected revenue target, but achieved 92% expenditure target. I think if we see an improvement next year, it will not be as drastic as to achieve 7.89 trillion naira revenue projection. So I think that looks too optimistic.
But with all of this now, would you say that the budget has what it takes to really promote manufacturing and local production and create infrastructure investments as the president already projected when you consider the 3.3 trillion naira earmarked for capital expenditure?
My challenge is that to even set out anything for spending it on capital expenditure, you need to first meet the recurrent expenditure of the government. As it stands today, I was happy when I hear one of the National Assembly members say that, look, we are currently spending more than 100% of our total revenue on recurrent expenditure, government overhead, not debt recurrent expenditure, personnel cost, as well as debt service. If you look at what actually happened last year, of the about 6 trillion that was spent on recurrent expenditure, total about 6 trillion was spent on recurrent expenditure, whereas total revenue was just about 4 trillion, giving you recurrent expenditure to total revenue of a deficit as much as 2 trillion naira. When you add the capital expenditure of 1.1 trillion naira last year, you realize that the budget last year was approaching about 4 trillion naira in deficit. And last year, we must know the fact that crude oil production was about 2 million barrels per day, and average crude price was about $64 per barrel. So with such strong revenue earnings last year, we only achieved a total revenue of 4 trillion, where even if you take into cognizance the adjustment in the exchange rate, how are you going to achieve 7.9 trillion? If you don't achieve that, you will end up not being able to incur the capital expenditure budget. Remember, the capital expenditure is what we call discretionary expenditure. You must meet your personnel cost, you must meet your other overhead, you must meet your debt service. These are non-discretionary expenditure. It's only when you have made the non-discretionary expenditure you can now spend money on discretionary expenditure. So the hope that we'll spend about 3 trillion naira or 3.7 trillion naira on infrastructure will be based on our ability to achieve the projected revenue, which I think is going to be a tall order.
Now, let's look at the deficit of 5.16 trillion, which is to be partly financed by a total loan package of 4.28 trillion naira. With that, do you get a sense of Nigeria's return to the Eurobond market next year?
Well, most expectedly, we're going to go back to the Eurobond market. But we also have to deal with the fact that we are getting to a point where our balance sheet as a country is becoming quite risky. Because today, you're looking at your debt service to GDP ratio has actually increased materially. I mean, not your debt service to revenue. And that's what matters most. Last year, our debt service was about 2.4 trillion naira of the 4.1 trillion naira revenue. If you take that as a percentage, you realize that debt service was more than 50% of our total revenue last year. And the more we increase our debt service, particularly if we borrow Eurobond at a time when our our sole major foreign exchange earning is crude, and that crude is actually not something that's within our control, we might actually be exposing ourselves to an uncommon, unexpected debt overhang. And we need to be very circumspect when it comes to going to the international market to borrow additionally at a point when our revenues are not strong. I think if we have to borrow, we have to seek for bilateral loans and lots of multilateral agencies. The Eurobond market is going to come to us at a very steep price, given our current foreign exchange reserve and the pressures our foreign exchange market is facing today. So lenders to the Nigerian economy will factor in those in the risk rating of our debt, and they will impose a risk premium that will make it quite exorbitant for us to borrow from the international Eurobond market.
Now, bearing all of this in mind, now talking about revenue, what are your expectations from oil revenues and tax receipts?
Well, the oil revenue expectation is dependent on what happens in the global oil market. We've seen OPEC and non-OPEC members have been able to stay strong and maintain the production quotas and the production ceilings they've imposed. We hope that they will stick together till next year and even beyond. Secondly, the rate of recovery of the global economy will also define what happens in the oil market. If the global economy recovers at a faster rate, you will see an uptick in demand for commodities, which will mean that crude oil prices will further strengthen. And that will be a critical factor in determining how much we earn from our crude. Then on taxes, now our tax revenue is dependent on the performance of the corporate organizations within the economy. If the economy is in a recession, corporate entities are not likely going to see increase in their profitability, and government may not be able to generate as much tax revenue. As if you look at what has happened in the first half of this year, which the minister highlighted in her announcement last week, you realize that the government revenue was only 68% of the projected revenue prorated for July. So because the economy was locked down, it was difficult for government to get tax revenues from corporate entities. So if the economy does not recover substantially, tax revenues are going to come under pressures.
Now, just before we wrap up this conversation, Mr. Chukwu, the Senate already said yesterday that they're suspending deliberations on the PIB till 2021. What are your thoughts about that move?
Well, I don't know why they chose to suspend deliberations on the PIB. Remember that the PIB has been national, going back and forth between the Federal Executive Council and the National Assembly for more than 12 years. I think it was first introduced by the Yar'Adua government. And that was in 2008. Now we're in 2012. This is 12 years gone. And we are not seeing the level of investment we should be getting in our the upstream segment of our oil and gas sector. And we must not lose sight of the fact that the value of oil will decrease over time as technology continues to improve on alternative energy sources. Some countries are already setting timeline for use of fossil fuel as energy source in their countries. And if we do not have an enabling legal framework that will ensure that we fully exploit this natural resource now when it has economic value, we may realize that at some point it will just be like coal, and there it's on the ground and nobody's exploiting it. We need to move fast, and I think there must be some sense of urgency to the National Assembly in addressing this law and as to create some definitive clarity on the legal framework for investment in oil and gas sector in Nigeria.
We'd like to thank you, Chief Executive Officer of Carry Asset Management, Mr. Johnson Chukwu. Thank you for sharing some of your time with us this morning.
My pleasure.
Our commodities market updates will be up next when we return in just a moment. Please stay with us. Welcome back. Head of Research at the financial derivatives company, Damilola Akibame, is here with us to discuss the latest burning economic issues at the domestic commodities market. Good morning, Damilola. Thank you for coming on the program.
Good morning, BC. Thank you for having me.
All right, now let's begin with the latest coming from the International Monetary Fund, revising its global growth forecast upwards by 4.9%. What will be your reaction to that?
So actually, the IMF is yet to release its growth forecast. It's going to do that next week during the World Bank and IMF meetings. And it's expected that the IMF is going to revise upwards. And that's because in the third quarter of 2020, there's been some improvement. So the economic crunch was not as deep as anticipated, and that's because we've seen more economies reopen, businesses are slowly picking up. And if you look at all the policies that have been put in place, we've seen unprecedented monetary policy actions being implemented, from interest rate cuts to quantitative easing, and even the global fiscal stimulus that has been released so far in 2020 is about $12 trillion. That's about 8.5% of the total global GDP. So all these have contributed to the slow pickup in recovery. And now, with that said, the IMF is projecting a recovery, but it's not going to be even across all the regions, and that's because of definitely the level of response by each country to the economic crisis. So, for instance, now advanced economies have adopted this whatever it takes mentality to reduce the impact on households and firms, whereas the poorer nations have adopted this whatever is possible mentality because of limited resources. So you're going to see a varied recovery across continents, across regions. Even in Africa, you're going to see the likes of Uganda, Ghana, Ethiopia still recording positive growth in 2020 despite the impact of the contraction, whereas Nigeria, South Africa, Angola are still going to be recording negative growth in 2020. So it just shows you that definitely, yes, it might not be as deep as anticipated, but then still there are still risks that are prevailing. For instance, now we've seen that, like I mentioned, because of the fiscal stimulus, a lot of the emerging markets have had to ask for debt forbearance, waivers, and all that just to be able to address some urgent balance of payment needs. And that has led to very high debt levels. The global debt to GDP ratio right now is almost, or it's going to be close to 100% by the end of 2020. So that's a major issue, especially for emerging markets that might slip into a debt default, which would obviously affect their credit ratings. Also, if there's the risk of the second wave, which we're already seeing in Europe and in the US. If that is experienced in Africa, which has weak health system, definitely that's going to be a significant issue. And also, Africa is exposed to the sectors that have been most affected by this coronavirus pandemic. So I'm talking about tourism. I'm talking about commodity exports. So obviously, the weak demand has affected these prices. So that is what we're seeing right now. But so far, if the vaccines, if we're seeing improved progress, for instance, the World Health Organization has said that hopefully before the end of this year, a vaccine should be made available. So if there's improved or speedy progress, that would have impact positively on the growth recovery prospects.
Which we all wait to see. Now, let's talk about crude oil prices. Now, they appear to be at least not doing so badly at about $42. Brent is trading at about $42 per barrel this morning, which, of course, is above Nigeria's benchmark of $40 per barrel in the 2021 budget. But what are the factors driving prices today?
Well, for now, the oil prices, why there was an increase was actually it's partly driven by the shortages that are occurring because of the Hurricane Delta that is slowly approaching the Gulf of Mexico. And bear in mind that sometime in August, we had the Hurricane Laura that also led to significant shortages, and that affected prices. But in the near term, oil prices are still going to remain volatile, especially as political uncertainty heightens in the U.S. with elections coming up next month in November. So we're going to see oil prices continue to trade around the $40 to $43 per barrel in the near term.
And let's bring things closer to us now. The NNPC is saying that it will end crude for fuel swaps in 2023 and rely instead on oil products coming from local refineries, of course, which it hopes to have running again by 2023. But what will be the implication of this?
Well, first of all, one is to understand what the crude for fuel swaps are. So basically, Nigeria sells crude oil to the likes of Vitol and Trafigura and then gets in return fuel. So fuel imports account for a significant part of the government import bill. And the fact that the NNPC is planning on stopping that by 2023, which also even coincides with when Dangote's oil refinery is supposed to come in place or kick in, that would definitely reduce the government's import bill. So that it's a positive thing. Again, then still, the refining capacity right now of the 4 existing refineries is about 440,000 barrels per day. So it's suboptimal, and that needs to be improved on. So if the refining capacity picks up, definitely the import bill will reduce, and there will be less demand on the external reserves.
And so this news came in yesterday about the National Assembly shifting deliberations of the PIB till next year, of course, to deal with Budget 2021. But what's your reaction to that?
Well, the oil reform, which is the petroleum industry bill, is a very important reform, is a very important bill, which, when passed, is expected to make the Nigerian oil and gas industry more competitive and attractive to investors. And it's been stuck in this stalemate between the executive and the legislative arm of government for close to 2 decades right now. And because of that, obviously, has dampened investor confidence. And every minute that the bill is left unpassed, Nigeria is losing money. And right now, the country loses about $15 to $20 billion annually just because the bill is yet to be passed. And it's expected to address issues ranging from fiscal concerns to even, for instance, talks about the NNPC being commercialized. And the thing is that if and when this bill is passed, it's going to lead to a complete liberalization of the oil and gas industry, which would attract the needed investment and production dollars. So it being delayed again till next year, yes, fine, the budget is important, but that bill too is also important. And in a time where you need to grab whatever you can get, if you look at what happened to capital inflows into the oil and gas sector in Q2, it dropped by 35% from what was received in Q1. If you even compare that to Q2 2019, it's even worse. It dropped by 95%. So that's just to show you that the level of investor wariness and uncertainty because this bill is being delayed. So right now, it's definitely sending the wrong message to investors, and that bill needs to be passed as soon as possible.
Now, let's talk about the budget 2021, which the president is expected to present very shortly. But when you look at the assumptions, of course, I'm sure you're aware of some of the key assumptions of the budget. How realistic are they to you? We've been asking this question, but I would like to get your views. Well,
most of the assumptions are overly optimistic. And why do I say this? So, for instance, now, you have oil prices benchmarked at $40 per barrel. A lot of analysts are projecting oil prices to trade around $49 to $50 per barrel, and that is a base case scenario. So, yes, if that happens, so that you could say that is fair enough. But again, that is you are working based on the assumption that demand would have picked up. You are working under the assumption that also the recovery process would have kicked in significantly and the COVID cases have declined. If that changes, then obviously you would have to revise your assumptions. Also, you're talking about the fact that you are projecting an inflation rate of 11.95%. The CBN is saying that inflation might even reach 14% at the end of this year. Something significant has to happen for you to bring inflation from 14% to 11.9%, meaning obviously you might need to tighten your interest rates, you might need to do so many things. So how do you marry both together? You are projecting a growth recovery of close to 3-4%. That also is very optimistic. So we think, but that's fine. Budgets are made for. It's not cast in stone. So, for instance, this year we had several revisions. So, if market realities differ from what has been budgeted, nothing stops the government, nothing stops the Senate from revising their assumptions. And more importantly, is even the borrowing aspect. It is clear that definitely Nigeria will still need to borrow because obviously the oil revenues or even the total government revenues are far below their projected expenditure. But what is of note, or the questions that everyone, the Nigerians, investors are asking, that, okay, this deficit, which is expected to increase to about 3.6% of GDP from about 3.2% of this year, which is still above even the Fiscal Responsibility Act of 3%. How are you going to fund this deficit? what are you going to use the borrowing proceeds for? And more importantly, what is the impact on the debt service? What is the impact on the debt service to revenue ratio? So I think those are the questions that are more pertinent and need to be addressed.
And then what about the exchange rates at 3.79 to the dollar?
Yes, that also. So right now, the official rate is about 3.80, and we've seen that all other rates are actually hovering around the IFX rate, which is around 3.86. We know that even right now, the parallel market rate is about 4.58, 4.60. So right now, we are seeing that a convergence occur with exchange rates, but there's the possibility that the Naira might still be adjusted. If Naira is adjusted, then your 3.79 exchange rate becomes academic. So that also is a significant variable that needs to be reviewed and made, and it should be realistic based on what is happening in the economy.
Now, another issue you guys have raised is the fact that Fitch Ratings has raised concerns over Nigeria's $2 billion forex backlog. Of course, we know that dollar demand has been swelling and piling up pressure on the Naira.
Yes, so Fitch's concern is not unfounded, because definitely the backlog of $2 billion right now, it's likely to increase with international trade resuming and businesses picking up. But the CBN has laid out plans to actually clear this backlog within 16 weeks. So that should provide some comfort for investors. But the thing there is that, okay, fine, with your cash flows or your forex inflows being constrained. We've talked about oil prices. We have lower oil proceeds. Remittances are down and are not likely to improve anytime soon. Foreign portfolio investments too are not trickling in as much as anticipated. And the demand is still there. So definitely the impact will be felt on the external reserves. And the CBN also is sort of like preparing the minds of Nigerians that, look, the external reserves may deplete to about $29.9 billion by the end of the year. Right now, the reserves are about $35.7 billion. So that means between now and the end of the year, reserves may fall by about roughly $6 billion. That's $2 billion per month. But that's fine, because at the end of the day, right now, our import cover is about 8.9 months. So by the time if it falls to about $29 billion, $30 billion, so maybe that will bring the import cover close to around 7 months, which is still fair enough. But more importantly is that if you clear the backlog, if you make the forex more available to sectors that have been affected severely by that crunch in forex supplies, for instance, manufacturing, trade, because there is now improved supply, investors too can repatriate their funds, and because they can repatriate, they're more incentivized to bring in more funds. That would help the market, that would boost the supply, that would even help the exchange rate. So I think with the fact that the CBN is planning to clear the backlog is a good sign. And even look at Fitch. Fitch recently, in the past couple of days, they upgraded our outlook to stable from negative, and they affirmed our rating at B. And that's because they cited, the CBN's forex management policies to an extent have contributed to this positive, in quote, perception that they have about the economy and also the recovery. So the CBN is doing right things, at least to an extent, in some cases, definitely. And I think that once the backlog is cleared, you are sending a positive signal to investors that, yes, you are at least doing something.
Now, let's talk about the global trade body, that's the WTO, which has predicted a 9.2% decline in the volume of world merchandise trade for 2020, and that's also followed by a 7.2% rise next year. Of course, this is a more optimistic outlook, but then what does this mean, particularly for Nigeria?
Yes, so the fact that the WTO is projecting that decline is not, it doesn't come as a surprise, because we all know what has happened to global trade and the disruptions that have occurred. So the impact definitely for instance, for Nigeria, that depends a lot on imported items. We're going to see that global trade flows decline significantly this year, but expected recovery next year it should provide some level of comfort. And for instance now, so because of the weak demand that is at play, so for instance now, Nigeria's cocoa exports, the demand, because of the low demand, that is affecting the prices. So for commodity, for exporters, countries that export or they're a net exporter, they would experience low prices for their commodities. And for those that are actually net importers, so for instance, Nigeria that imports a lot, because of that weak demand and even supply to a lot of production. Fine, there's a gradual pickup, but production levels are not yet back to pre-pandemic levels. So because production and supply has also been affected, you will find out that despite the fact that prices have dropped, but because there are now shortages, because supply is not being met or released as frequently as possible, that also would inch up the prices in the local country. So definitely global trade flows are down this year, but we expect to see a recovery in 2021. But the risk there is that post-COVID, there's a possibility that countries may now shift towards protectionism. And if that happens, that would affect the free trade policy. So we're talking about after taking up next year and whatever. So that is just that risk about it when we're talking about trade.
Now, let's quickly touch commodity prices. Now, of course, we've seen gari, tomatoes, and rice prices go up. What's driving the prices up?
Well, we've been talking about flooding affecting a lot of commodities. So the flooding in most of the food-producing regions, that has actually led or contributed to the increase in the food prices of tomatoes, gari, rice. And also bear in mind that as we start getting closer to Christmas, increased demand for all these festive-related commodities, if I can call them that, would also contribute to an uptick in prices. And the harvest season too is basically almost ended. It's because the rains were delayed, that's why. But the harvest season is almost ended. Supply levels will thin out. So with that said, we're going to see prices still remain sticky downwards, and they're going to be elevated. But compared to previous years, because of income levels that have dropped significantly, the demand for these commodities might not, at least especially during Christmas period, might not be as much as previous years. And bear in mind also that there are still social distancing measures put in place. So the volume of people at parties, at events, will definitely reduce, and that would affect demand.
We'd like to thank you, Head of Research at the FDC, Damilola Akibami, for coming.
Thank you, BC.
Well, it's time now to review yesterday's trading at the NSC with Eddie Diong Iwang. Good morning, Eddie. So the bulls, or the bears rather, finally showed up at the markets yesterday. I'm sure that didn't come as a surprise to many.
Good morning, BC. You're right. The market snapped its 12-day rally as local investors decided to book profit. And like you said, people just wanted to cash out on the gains that they have made in the previous trading sessions. And that dragged the all-share index by 0.95% to 28,634.35 points. And that brought the month-to-date and the year-to-date gains to about 6.68%. We left the 15 trillion naira mark and dropped to 14.966 trillion naira yesterday. Now, although the market was down yesterday, activity was higher as volume was up by about 11.21% at 832.87 million units, worth 9.53 billion naira, and all of that was changed in 9,180 deals. The sector chart was mostly negative yesterday, apart from oil and gas, which gained 0.24%. Banking was down 3.27%, as we saw losses from GT Bank, UBA, Zenith Bank, Access Bank. Consumer goods was down 0.10%, and that was due to losses on Guinness and Unilever. Industrial goods was down 0.38%. Of course, that was due to the losses or profit-taking rather on Dangote Cement, while insurance declined 1.98%. Let's talk to Rotimi Fakaijo, a stockbroker, for more. Good morning, Mr. Fakaijo. Thank you for joining us on the program.
Good morning.
So the losses yesterday in the markets were expected, but do you think those sentiments will continue, and is that the end of the bull run?
Well, it's not the end, because if per adventure in a day, we have securities gaining upward of 9-8%, then definitely we expect that there will be a temporary bear run on the market. And that was exactly what happened yesterday after the most price rally that we have had for a very long time, day before yesterday. So I believe strongly that what we saw on Tuesday is definitely going to be sustained, although it's not it may not be in the immediate. But even with what is already happening in the market this morning, we're already seeing a gain of 0.1%, and I expect that to rise as the market continues. So what we saw yesterday definitely was a knee and jerk reaction, which was normal. Definitely, we are sure going to see a rebound of the market today.
So with the low interest yields in the fixed income space, should the equities markets be expecting more participation in that space?
Well, we is a good thing that is happening, because whatever that is a demerit or disadvantage or a setback to the fixed income market is always a booster to the equity market. And I think this that we have seen, investors are going to capitalize more on it, because even if it's just dividend yield that investors look out for in the equity market, is more than enough to be more. I mean, it's more than what you can get now in the fixed income market. So I believe investors are getting wiser, and the only way the prices can be sustained is more participation in the market, and for people to hold on to their equities longer than the usual speculations that some investors usually do.
All right, Mr. Fakaijo, thank you for your input on the program. Rotimi Fakaijo is a stockbroker. We'll have to take a break on the markets. Over to you, Bisi.
For the debt and currencies market plus will also be crossing over to London, and that will be when we return shortly. Please stay with us. Let's now go to London, where Juliana Olayinka is waiting to give us updates on today's business headlines coming from the UK. Good morning, Juliana. Well, figures we're getting this morning says coronavirus restrictions are to be further tightened in parts of England early next week, with the possible closure of bars and restaurants. But do we have further details of the new restrictions, and how are the industry leaders reacting to this news?
Well, nothing has been confirmed yet, but sources close to Downing Street do believe that Prime Minister Boris Johnson is just a couple of days away from plunging about 3 to 4 million people that live in the north of England into some sort of lockdown. This has been triggered because yesterday the First Minister of Scotland, Nicola Sturgeon, imposed pretty draconian measures in Scotland as the rate of infection is increasing rapidly there. She actually does believe that a second peak is on its way, similar to what she saw in the summer. In just 2 weeks' time, they already had varied restrictions thus far, but now pubs and restaurants are barred from serving alcohol indoors. There are also some places inside central Scotland, which I believe affects about 1 million people. Pubs, bars and restaurants are actually closing, so the hospitality sector is going through another serious issue. At the moment, I believe the Scottish devolved government are allocating about £40 million to try and assist those whose livelihoods are going to be scuppered once again. And it's really this urgency that's coming from Scotland. You know, there's been lots of talk in Britain about the nations, all the 4 nations, Northern Ireland, Wales, England and Scotland doing their own thing. Scotland appeared to have been taken the lead under Nicola Sturgeon. So yes, because of what she announced yesterday and the rate of infection that's really rapidly increasing in parts of northeast and northwest England, that Boris Johnson may be doing this again. But he is going to be facing a lot of scrutiny about this. I believe the latest infection rate in the UK yesterday was about 14,500 people. About 70 people died. And of course, you know, you can put out all these statistics. These are real individuals behind these deaths, and my heart goes out to them. But in the peak, we were having 100,000 people being tested positive a day and about 1,000 deaths a day. So there are a lot of people, including Rishi Sunak, the Chancellor of the Exchequer, Alok Sharma, the Business Secretary, who are worried that Boris Johnson is going to go too far. So there's a huge split in the cabinet. On the one hand, you've got people like Michael Gove and Matt Hancock, the Health Secretary, really telling the Prime Minister to be tougher on restrictions. And then you've got the business side, who are completely concerned about the livelihoods of individuals, especially because the government's furlough scheme is coming to an end at the end of this month. And we're expecting a wave, a tsunami of job cuts. So it's a huge issue we're going through. But no doubt of the matter, the cases here in Britain are exceeding. And perhaps, yes, these lockdown measures could be announced later today. We just don't know.
We'll wait to find out. And there's more bad news, Juliana. Manchester Airports Group has announced plans to cut up to 900 jobs in response to a fall in passenger numbers and the end of the government furlough scheme. Of course, this doesn't come as a surprise. Of course, we know that the aviation sector has been dealt a very big blow caused by the pandemic. But what other changes will the group be making to ensure the future of the business following the pandemic?
Well, I don't sit on their board meetings, but I can only presume that some of these changes, unfortunately, especially for the aviation sector, as you said, Bissy, they've taken the lion's share of the tough choices that has had to be made during the pandemic. But the Manchester Airport Group, MAG, they actually oversee 3 airports. So these job cuts will be taking place in Manchester Airport, London Stansted Airport, and East Midlands Airport. And they said that they did try and ask staff to take a 10% cut in pay. They've also tried to lay off some of those middle management roles, but it's just not enough. I believe between April and June, they had about 2.8 million passengers. This period last year, they had 30 million. So you can see just how that's like a 90% drop, isn't it, in passenger numbers. So Unite, the union that looks after those who work in the industry, they're not happy. They don't believe the government's doing enough. Of course, the government is saying, you know, we put your staff on furlough. There's only so much more we can do, but it's particularly the regional areas. And as we know, aviation, as you were pointing out quite rightly, they have suffered the worst of the job cuts, particularly in the Western world.
And still talking about the aviation industry, EasyJet is calling for help for airlines as the budget airline wants it lost up to £845 million last year. Now, that's really huge in its worst crisis in history. Here we go again, Juliana.
Yes, here we go again. It's the same sector, and it's been a huge issue. You know, there are so many people. In fact, over 1 million people in Britain went on holiday during the summer. Yes, they still went on holiday. People are still flying, and there was that huge corridor. So Britain did allow people to travel to certain destinations to come back and not quarantine. That was up in the air after about 2 weeks, as they just saw the infection rates skyrocketing. And so EasyJet, in the final quarter of this year, they've reduced the amount of planes that will be flying out and the amount of destinations they'll be going to. That's not enough. They also very early on in the pandemic received one of the Bank of England's emergency corporate coronavirus loans. I believe that was about £600 million. They've got thousands of their staff on the government's furlough scheme. But again, these measures are just not enough. They're a short-term solution. And I believe that EasyJet bosses have been speaking to officials in Whitehall, the civil service, basically just laying out some of the problems and just letting the government know that in the next couple of months, winter could be really crippling for the industry, and they could potentially need another loan. Now, all of this information has actually been leaked by a source, so we're not sure. I believe EasyJet released a statement after the leaking of this information saying that at the moment they've got enough in their coffers. But as we've seen with other big corporate giants, they are likely going to have to ask the government for some state aid because COVID-19 is going to be with us for the foreseeable future. Even if there is a vaccine, the vaccine will not be available for everybody. So it's trying to find a way and a solution. And this is, I believe, part of the discussion that EasyJet were having with civil servants yesterday.
All right, Juliana, thank you for those updates. We'll talk to you again at 1:30. All right, let's get back to Eddie Young for a review of the debt and currencies market. Back to you, Eddie.
Thank you, BC. Well, bond yields eased yesterday due to fairly system liquidity. On average, yield declined by about 36 basis points as we saw declines at the mid, short and the long end. We had 22 deals worth 6.57 billion naira on that segment. At the Nigerian Treasury bills market yesterday, the average yield trimmed by about 2 basis points to 1.5%, while average yields contracted at the mid and the long end. We saw 12 deals worth 20.63 billion naira, while there were 7 deals worth 11.38 billion naira at the almost segment. But let's quickly talk to Chukudi Nwa-Okeke, the chief dealer at FSDH Merchants Bank. Good morning, Chukudi. Thank you for joining us on the program.
Thank you. Good morning. Thanks for having me.
So with OMO maturity repayments due today, how will that shape system liquidity for the rest of the week and into next week?
Okay. For today, we have 576 billion maturing at OMO, boosted by liquidity of about 386 billion from yesterday, which takes us to about 960 billion, which makes the system very, very liquid. We also have FX refund coming in today. take it to be about 1 trillion market being off today. Going into today, for the rest of the week, we expect markets to remain liquid and rates to remain low. We've seen money market rates range between 0.5 and 2% on overnight, while 0.5 for OBB. So going into next week, we expect market to be liquid. For most part of October, the system is also expected to be liquid, as we will have huge maturities from OMO for the month of October.
Chukudi, thank you for those updates. Chukudi Nwao KK is the chief dealer at FSDH Merchant Bank. We'll have to leave it on the market review and just hope for a positive trading day. Over to you, BC.
Thank you, Eddie. And that's where we wrap up today's program. Thank you for watching. I am BC Adebayo.